That's how we are dealing with them. So the point of interest for the day is whatever the security you call it as. By the way, quickly, can you tell me what is a security? A financial security rather. Anyone try? Yeah. There's something? Sorry. Okay. As I was telling in the previous class, if you have a CD on your name in a bank, that is between you and the bank, it cannot be transferred. So it cannot be traded. Why? It is not a security. Okay. So you take any agreement between two parties, which is traded, which is not traded. Traded means it's a security. Let it be debt or equity. How do you differentiate a debt and equity instrument? A debt instrument or equity instrument, any debt instrument. Can you try? Okay. Can you give me the example of a debt instrument? Yeah. A bond, a debenture, a treasury note, treasury bond. These are all the examples of a debt instrument. What is an equity instrument? Equity, stock. Stock, share, equity all mean the same. So my question to you is, what's the difference between these debt instruments and this equity? What could be the difference? Yeah.
The instrument has like a period of time versus stock.
Perfect. A debt instrument has a fixed tenure, 1 year or 1 week, one week, 1 month, 1 year, 10 years, whatever. Equity doesn't have any maturity. There is no fixed timeline. Similarly, returns are fixed, are known here, promised. Fixed or floating, it is promised, assured. But here, higher the returns, higher the dividends, capital gains. Okay. Debt instruments, no ownership. Equities are the owners. They don't have the voting rights. Equity have the voting rights. Okay, got it? So now we have seen debt instruments are list and equity when you're talking about securities. We may also have other securities like derivatives, money market instruments. Money market instruments are also kind of debt instruments, but for short term. So what I'm trying to say is debt instruments, equity instruments, and derivative instruments. All these have a strong connection with interest rates. Interest rates make those instruments value go up or come down. That is the topic for the day. Okay. Then let me show you the learning goals for the day. Like we'll be seeing different types of returns, required rate of return, expected rate of return, and realized rate of return. And we can also talk about more if I have or you have. Then we'll be quickly going back on bond valuation, bond prices, how they are valued, and equity valuation, equity prices. Then role of interest rates in security prices. You'll be knowing this. And how the maturity and coupon rate will affect the price in terms of its sensitivity to the rate changes, interest rate changes. And something interesting for the day, you will be learning maybe something new for you, if I'm not wrong. You will be learning duration and how these three will influence a security. And finally, economic meaning of duration. I missed one thing. I will also introduce something called convexity. Okay, these are the learning goals for the day. We'll be a little quick on these topics. Let me know if you have any question or want to know more on something which we are talking about. So this is how I organized. First, we'll start with the rates of returns, then bond prices and valuation, then equity valuation, then impact of the interest rates on this, duration, and finally convexity. So when you talk about rates of return, I think when you talk about rates of return, there are many actually, the way you calculate and so on. Here we are talking of the rates of return where you get from a security in terms of its issued returns, unissued returns, which are volatile and so on. So we all are aware of coupon rate payments. Whenever I tell you what are the returns on a bond, you can say interest rate or coupon rate, both mean the same. There's no difference. I think I forgot to miss that. All these slides are available to you on Canvas. You need not be in a rush to write down all these things. They're very much available. Already it was uploaded into the Canvas. Then required rate of return. We will discuss that in depth, but quickly, required rate of return is what you want. Okay. Expected rate of return is what an investment can give you. These two are the difference. The difference between required rate of return and expected rate of return. For example, you want to invest in a certificate of deposit and your required rate of return is say 5%. You can't. It gives only 3.5%. Okay. So expected rate of return on a CD in Chase Bank is 3.5%. You want your required rate of return is 5%. Then better go for other securities. That's how you need to make the investment decisions by working on required rate of return and expected return. Then realized rate of return is the promise, the what you will get in future. And realized return is what you get. A company may say, the CEO may say in its annual board meeting, next year we are going to give 100% dividend. That is promised. But after 1 year, you will know whether you got 100% or more than that or less than that. That's what you mean by realized rate of return. Then real rate of return is something related to inflation. Whatever the return you get from any kind of investments, as we are talking about securities, let it be in a bond or debenture, equity share or anything, say you got 6% return. And what is your current inflation rate? Deduct that. That becomes your real return. Every country calculates its GDP as well as real GDP. What do you mean by real GDP of US? The GDP adjusted to its inflation on quarterly basis. So whenever you see the word real, it is talking about inflation. Okay. So more on that, I just had this for you. Now, when you're calculating this, you have seen, right, in your financial management classes. Is this okay, or you want some explanation on this? Is this okay? Comfortable to you? It is known to you all, right? No explanation is required here. So why I'm talking about this is a timeline where an investor is receiving these many cash flows for these many years. Okay. Then what is this R? This could be, I didn't say anything. This could be the return on a bond, the return on equity shares. It could be coupon payments on a bond or dividends on a bond. We don't know. I just generalized. Okay. So for the first year, you'll be discounting this first year cash flow divided by 1 plus your required rate of return. Okay. Same is the case with second year, third year, till nth year. If your bond has a tenure of 10 years, do it for 10 years divided by 1 plus your required rate of return whole to the power of 10. That will give you the answer. The short form of this formula is this. Okay. Whenever we talk about discounting of bonds, in practice, usually it is semi-annual. Okay. Textbooks may give you annual or semi-annual or quarterly coupon payments also, but in reality, most of the companies pay their interest rates once in 6 months, twice in a year. You have to take care of that, because here CF1 does not mean first year. Okay, first 6 months, second 6 months, third 6 months, and so on. So if you have the data for yearly coupon payment divided by 2, if it is a 10-year bond, it becomes 26 months periods. So don't get confused, importantly, when you are working on Excel. Okay. So how do you make investment decisions based on the required rate of return and expected return? So when you discount the cash inflows based on your required rate of return, you'll get a present value. Okay, that becomes the price. That is the base for the markets to trade the securities with a given price. That's the benchmark. So as I told you, required rate of return is what you want, and expected return is the probability a security can give you. If it is a bond, there is no probability. If it is a fixed coupon rate bond, there is no probability. But if the bond promises you floating rate where your coupon payments are based on interest rate changes, then you have to assign some probabilities. That applies here also. If it is fixed rate, there is no probability here. 100% you will be receiving mentioned coupons. Okay. So when you, how do you make the investment decisions? If the expected rate of return is greater than required rate of return, it is undervalued. Okay. So I think I was giving a plain flat example of a CD, which is giving a 3.5%, but you want 5%. Okay. So which one matches that in our case? 1, 2, 3. CD is 3.5 and you want 5%. Which one matches among these three? Our example. Can you try?
Can you repeat that?
Second one, the question you are asking, CD is offering you from a bank 3.5%. Okay. So is that expected return or required rate of return? That is required rate of return or expected return? All of you, please. CD is offering 3.5% and you want 5%. So which one is required and which one is expected? 5% which you want is required. Which you want is required. What you get from your investment is expected. Got it? So what is expected in our example? 3.5% from the CD. Your required rate of return is 5%. My question to you is, which of one of these three will apply here?
Overvalued.
Overvalued. If expected rate of return is less than required rate of return, it is overvalued. So this is a strategy for any securities in general. Okay. So overvalued means you want 5% and it is giving you only 3.5%. You don't buy it. Okay. And the other way, you want 5% and some bond is offering you, say, 6%. It is undervalued. You go for it. You invest it. That's how you make the investment decisions. So I think fairly valued, required rate of return and expected return, they are the same. Yeah.
Both value and value are less than required rate of return. How do you know which is which?
Oh, that's an error here. Thanks for pointing it out. This is equivalent to. That's a correction. So fairly valued is expected return or is equal to required rate of return. Thanks for that. And one prompt to you all, whatever we talk or whatever you read from the book or whatever, there could be always errors. Your learning is important. If you learn, you can point out anything. Okay. These slides I am preparing only for you, and you also have the slides which are given in your canvas course shell. You can go through that or this. My idea of doing this is to come out of many errors, but still there is a scope. Okay, so I think let me correct right now. Can I do that? Yes, I can do that. This looks good. Okay, so this is how you make compare required rate of return and expected rate of return. One more way of looking at required rate of return is you're lost. What should be my required rate of return? I don't know. You have money, but how much you want, you don't know. How do you arrive at required rate of return? You go with current interest rates in the market. That becomes your required rate of return. Okay, we'll see that more while we progress. So I put only two, debt instruments and equity instruments. I'm not talking about derivatives. In fact, derivatives are also influenced by interest rates. Black-Scholes option valuation has rate of interest, which determines the option values and so on. So when you talk about bonds, I think these are the things we have to worry about it. We'll be looking into it, but I just gave a prima facie picture of the all. We'll be seeing all, yeah. Okay. In line with what we discussed earlier, overvalued, undervalued, and fair value. So I'm bringing the same to a bond. You have a premium bond. You have a discount bond. You have a bond at par. These are the three probable. I'm not giving you any activities this class, but when we switch on to debt markets and equity markets in the later sessions, we'll be working in live with the markets, how they are, how many of the bonds or which bonds are at premium, which bonds are at discount, and so on. I can't stop you after the class. You can go through it and let me know if you have any question. You can email me anytime. So premium bonds are at premium. What does that mean? It means that the coupon rate on a bond is greater than the required rate of return. Okay. So again, there is a catch here. As I mentioned, when you say required rate of return, it is usually current market interest rates. So the coupon rate of a bond is more than your required rate of return or existing interest rates. The bond is at premium. A quick question, why? What could be the reason? A bond which was already issued maybe 2 years back or 3 years back, it is offering 8%. And the current interest rates are around 6%. Now I'm saying that the 2 years back issued bond is at premium. Why it is at premium?
When it was issued at the current market rates.
Okay.
And the interest rates fell.
Okay, agreed. Yeah.
Yeah, so it's kind of
The same. Okay. Maybe as an investor, premium means you're paying more price for that.
Yeah.
You got the point? Premium means it is trading at higher price. The reason is right now the bond is that kind of bonds are offering only 6%, but it is offering 8%. I'm getting more. If I buy that, I get more coupon payments. So there will be more demand for that. Every one of us will be willing to buy that. That makes that bond at premium. Opposite to that is coupon rate less than the required rate of return. Right now, the bonds are offering at 6%, but I'm sorry. Don't know how to make it calm. Okay. Earlier, there was a bond which was issued for 4%. Right now, we all are getting 6%. We are no way interested to buy that bond. Okay. So that makes the bond at discount. So at par bonds, right now we have 6%. A new bond is offered by a company for 6%. And already there are many bonds which are also offered for 6%. They trade at the same level. There's no difference. Okay. So that's how we look at a premium bond and discount bond. So one more thing when you talk about yield to about bond is YTM or yield to maturity. I think I'll show you. We'll talk more when we talk about debt markets. But a quick introduction about it, or reintroducing YTM. When you have all the bonds, all the cash flows of the bond, including the future maturity value, and you have present value. Present value in the sense it is trading in the market. Okay, a bond is getting traded for $950 today, and the time left for is say 4 years. You discount all the semi-annual 4 years coupons as well as maturity value after 4 years to today. That itself is the price. But when you take your required rate of return, what you do in YTM is all right hand side one side, left hand side one side. Left hand side is the bond price, right hand side are the cash inflows of the bond. You equate at a rate by keep on changing the discount rate. I will be showing you that. So the rate which matches the present value, the bond price, and all the discounted future cash inflows, that you call it as YTM, yield to maturity or yield till maturity. Okay, we have that. I'll show you more. So as quickly as possible, premium means price are higher than what the bond is offering. Discount or the face value. Discount means price is low than what the bond has offered as face value. Par bond, both are same. So when you look at the pricing or finding the value of a bond, there's a simple formula like I showed you the previous one. Now we are specifically talking about a bond. So you have the future values, which is a coupon, as well as the face value or the future maturity value. Then the frequency of the payments, usually it is semi-annual. Then you have the required rate of return. Repeat, I'm telling you, required rate of return is the current benchmark interest rate. So what's the benchmark interest rate here? Maybe it's too early, we'll be talking about, but still, let me give you quickly. If it is for a 1-year bond, you should take a treasury bill kind of instrument to compare as a current interest rate or required rate of return. If you are looking at a bond which is for long term, say 10 years, then you should check a treasury note or high rated corporate bond as a benchmark, which will be used as required rate of return. So based on the tenure and who is issuing, your required rate of return differs, which is a benchmark. So same thing getting repeated here. I just gave an example. If any one of you are using finance calculator or using Excel, you can cross check if you want. Let's spend some time on this. This is a $100 semi-annual coupon bond of 3%. Semi-annual means you'll be getting 1.5%. Will be redeemed after 22 years with a yield to maturity of 4.293. So here, your yield to maturity means your K or R or required rate of return. Can any one of you try using Excel? This is a simple formula.
You try to find face value?
Sorry?
You try to find face value?
This remains the face value. The future value is the $100. Yeah. Maybe that's a good question. Actually, some bonds, it happens rarely, they mature the bond at a premium. Instead of $100, they give you $105. That is little rare. But usually face value and maturity value both are same. So what I did is your coupon payment will be $1.5 a year for 6 months, 2 times in a year, okay? And divided by R is 4.293. This is for a year. For 6 months, it will be 2.1465%. Okay. To the power of the last one will be 44 to the power of 44. Okay. You can try later also, but yeah, just have a start on this so that all will be connected. That's the idea. You can cross check the answer. Again, I'm telling you. I didn't give the answer actually. Let me check if you have. Yeah, I used Excel here. That's the reason I didn't show you here. So the answer is 81.7117. Just cross check if you all had the same answer. So I gave you the values, okay? And I also gave you how to arrive at the price, the coupon, and days in coupon period, and so on. I gave you the whole. You can try at your leisure time. I think the whole thing is here. Nothing is missing. So you're connected back to your bond valuation with a given set of coupon payments and a future value and required rate of return. This is how you are going to calculate. So again, I'm telling you, use Excel, Excel, Excel. Be good in using Excel. All the functions are very easy. They are user friendly. It's the other way when you're asked to say what is the YTM of a bond. You know the present value, which is the bond price, and you have the coupon payments, and you have the future value or the maturity value, and you need to find YTM. So manually, in the olden days, when we are doing our MBAs long time back, we used to manually do on trial and error basis, and it used to take a lot of time. But using Excel, you can instantly get it. So this is the example. For that also I have $100. The coupon payment is 8%, and maturity or tenure is 30 years. Check this out and let me know your answers. This is very easy on Excel. Manually, it is very difficult. Difficult in the sense, time-consuming process. So I put everything here. It's very easy. Okay. So at your leisure time, please try all this. If you have a question, you can please let me know. I'll love to answer those questions. So any question on bond prices and valuation, required rate of return, YTM till now? Because we are switching to equity. All good? Yeah, thank you. That's good going. Then same way, same thing if we apply to equity prices and valuation, it is the same, but it is different because as our friend said that debt securities have a timeline, equity doesn't have. That's the difference between debt and equity. So equity valuation has a different flavor, but still we have the same required rate of return. We'll be using the same K or R. Again, to tell you, in the previous examples, formulas, we used YTM here, okay? We used R here. Some books will be using K. It doesn't matter, okay? All are discounting factors or required rate of returns. All are same. So here also, while arriving at equity value, we'll be using the required rate of return again, okay? So what we do here is, the difference here is, unlike a bond, we don't have a fixed future value. Like we had a future value here, and no equity share will promise you a fixed equity price after 1 year or 6 months or 2 years or 10 years. No. So then how do you find the equity value? We are just rediscovering again. So to arrive at equity value, what you need is the future cash inflows. Okay. There are two ways of looking at equity value or valuation of equity. Most popular one is dividend discount model. But the problem is, how do you value a company's equity share when it is not paying dividend? Microsoft for several years, it didn't pay a single dollar as dividend. How do you value that? Okay. So keeping that in mind, you have different models of valuing equity. So popular model is Gordon's dividend discount model. And you also have cash flows discounting model. So what do we do in that? We have free cash flows of the company in totality, and we discount them like we do for dividends that I will show you. Okay. So for the time being, we will limit ourselves to dividend discount models. Process is the same for even cash flow discounting. So you need the dividends, future cash inflows, and we need the price. This is something interesting. I thought some of you will ask. We are trying to arrive at the value of equity, but I'm saying the price after some time, price after time t. Okay, it happens that sometimes you want to buy a share, but you don't want to hold it forever. Okay. By the way, any one of you are holding stocks of any company here? You hold it? Which one may I know that? Which company? What's that?
Google.
Google?
Yeah.
Okay. Anyone else?
I'm in a lot, but Micron, Nvidia, Google, Walmart.
All tech giants who shake the indices. Yeah, someone, you said that? Anyone else holding the stocks? Yeah, which one?
You know, Apple, some defense stocks now, the defense ETF.
Good to hear defense stocks. Defense stocks, which one the cyclical defense stock, that kind of defense, or real defense products?
Defense.
Okay.
Lockheed Martin. Some other ones. I just got an ETF. I don't know the names of like all of them.
Okay. Good to know that. I don't know, for some reasons, all the youngsters love the tech stocks, right? Apple, Nvidia, Google, and so on. I will take you to all those stocks and it will be very interesting in the next classes. But why I'm asking you right now is, when you buy a stock, you should have a clear investment goals. Why are you buying that stock? Which means target return. Like Warren Buffett says, buy the stock and forget it. He doesn't buy a stock, he buys business. That is his strategy. We are not talking about him. But you talk about investors like you and me, or institutional investors who trade a lot on stocks to make instant money or maximize the capital gains. So they have a clear timeline. I'm looking at Google to get a return of 20% every year for 2 years, something like that. But no one wants to stay in Google stock holding. So why I'm telling you all that is price after T. Sometimes when you're asked to find the price of a present value of a stock, when its future price is given, how ridiculous it is when we don't know the present value of a stock and we are struggling to do that. How do we do that? So the mechanism is that we have the valuation models. If you are planning to invest for a year, Every year, I have many known friends who are investors who buy every year in the month of Jan. Jan has a calendar anomaly and behavioral issues. They beat CAPM, they beat market efficiency. Nothing works in the month of Jan. So taking this as a strategy, he invests every time in the month of Jan. So he tries to sell in December or November, something like that. Again, he joins in Jan. So for that kind of investors, they look at 1 year valuations. Some investors, they go for 2 years, 5 years, or 10 years. Some investors may invest for forever, like Warren Buffett. They never sell, they own it. Okay. So in this contrast, let us see how the prices or stocks are valued. If it is 1 year, you should have the expected dividend after 1 year and expected price after 1 year. So how do you do that? This is based on next year dividend can be expected based on current year dividend and historic dividend paying years. Okay, that's easy. But how do you arrive at price after 1 year? So all the analysts, advisors, they give the price forecasting, all the investment advisors. So that could be one criteria, or you can have your own base. Okay. So when you discount the price expected after 1 year and dividend expected after 1 year with your required rate of return, you get the intrinsic value or equity value or fair value of a stock. Okay, this is how you'll be doing this. So I think this you can quickly answer actually. Can you give an answer for this? Dividend after a year is 350, price after a year is 45, and your R required rate of return is 25%. What's the present value of this stock? Can you all do it quickly? Just for 1 year. You can use any calculator also for this. Simple calculator will do. Dividend discounted by this 1 plus R is 25%, so 0.25. So dividend discounted by 1.25, price discounted by 1.25. You will find intrinsic value. I just want to cross check the answers from you with the answer here. That's the idea. How much? 30? 8.8. Okay. Any other answer? I got one answer from your friends. $38.80. You got the same? Yeah. Okay. Let me check. Yeah, I'm also right. I'm with you. $38.80 is the present value of this stock. If you expect this stock to give $45 after 1 year and $3.5 dividend after 1 year, and it is worth of $38.8. Now, question to you. This stock is right now trading at $40. Will you buy or you don't buy? Don't buy? Anyone else? I repeat the question. Our fair value of the stock is $38.80. And right now, you want to make an investment decision on this, which is getting traded for $40. What do you think? You will buy or you don't buy? Yeah, you don't buy. Go back to our formula. This is the fair value is less than the market value. Okay, so market value is overvalued. The market value is more than the value which we calculated. It is overvalued. If it is anything less than $38.80, the market price, say it is getting traded for $35, it is worth. Even if it is getting traded for $38.80, yes, that's the value. You buy it. But anything more than 3880, it is not worth. That is how we arrive at investment decisions using equity valuations. Okay. That is for 1 year. Then if you have the information for more than 1 year, like 2 years or 3 years or 10 years, you can do it. So I have one more example. Can you quickly do this? First year 350, the same. Second year $4, and third year $450. And at the end of the 3 years, the price is expected to be 75. And your discount rate is the same. Can you tell me the answer, please? If you have done for 1 year, just copy paste for 2 more years and sum it up. Okay, you can continue later also, but check with my answer, cross check whether it is right or wrong. It is $46. Okay, so I think the simplest form of calculation is when you have dividends forever, no growth rate, nothing. It is simply D by K. Dividend divided by K, easiest way to calculate. I have an answer example. So when perpetual dividends are $3.50 and your K is 0.25, your fair value is $14. And I also have dividends with growth. Dividends are not the same, they're changing. Means increasing, positive change, increasing. If that is the case, you have a formula for 1 year. I have an example here. And growth for multiple years, forever. Again, this is the simple one. So no growth, D by K. With growth, D by K minus G. These are the simplest formulas to remember. So that was debt and equity. Now, let us see more of impact of interest rates on debt and equity. Whenever interest rates go up, the bond prices come down. Okay? Whenever current interest rates from previous quarter or previous month or previous week, when interest rates go up, bond prices come down because the K, the denominator, the discounting factor is increasing. So present value will come down. If discounting factor is decreasing, present value will go up. They're inversely related. Same is the case with equity also. I think that is shown on the graph here. They are negatively related. This is what you call it as convexity. I think some explanation of this. So we have the bonds price sensitivity seen with the duration. I will explain you more. This is more descriptive. So the big relationship is higher the bonds coupon rate, higher its present value at given. I mean, future when you discount, it's obviously clear to all of us. High coupon payments will lead to high present values. Then important thing, maybe new thing. How many of you are aware of duration? Did you hear about this anytime? Anyone? Okay, yeah, got it. Got one with me. Thank you.
Can you explain it more? Because I was doing the homework and I couldn't understand.
Oh, good. Thank you. So duration, this is more about bond portfolio management, where I want to hold the bonds not till maturity, but only to some time where I get the maximum benefit out of it. So in that context, duration is measured. Okay. So let us see one after the other. So it is a bond is say 10 years. Corporate bond has a 10 years maturity period. When you calculate its duration, obviously it will be less than 10 years. So the flat rule is duration lies between 0 to maturity period of the bond. That's the idea. And if you have a zero coupon bond, what is a zero coupon bond? Any guess?
On payments.
As simple as that. There are no coupon payments. You get everything on the maturity. So if you want to calculate the duration of a zero coupon bond, its maturity itself is the duration. Maturity period and duration are the same for zero coupon bonds. So what makes a duration change? For example, I calculate a duration of a bond and I get, say, it is a 10-year bond. I get the answer as 8 years or 8 point something. What does that mean? It means that any bond has interest rate risk as well as reinvestment rate risk. Okay. So what do you mean by reinvestment risk? Any guess? Yeah.
Like the coupon that you're getting for the bond, that specific amount of money going back into the market.
Okay. I agree. Maybe one more question. I'm putting a lot of questions. Don't take it otherwise. Does zero coupon bond has a reinvestment risk? No. Why? Because it doesn't have any coupon payments. When do you have reinvestment risk for a coupon bonds? The answer is you invested in a bond at 8%, say for example, and the reinvestment risk is what if later interest rate comes down? You get the coupon at 8% and you try to invest it somewhere else, it will be less than 8%. The other way, you bought the bond for 8% and the interest rates are increasing. You're happy because you got the coupon at 8%, you reinvested for 8.5 or 9 or 10. But either way, there is a investment risk. Coming back to duration, it is the point where interest rate risk and reinvestment risk are the same. So beyond that, you don't get much from the bond. So that's how bond portfolio managers, there are many funds which offer bonds with which are duration based. That is the idea. So it's all about price sensitivity to the interest rates. So again, I'm telling you, longer the tenure, higher is the sensitivity. I think this is what I was talking about, price risk as well as reinvestment risk. So it is applicable to fixed coupons, not for zero coupons. And how it was arrived is what you do is you take the weighted average of each coupon. Okay. So 1 times first year, first period, you can say 2 times means the immediate one has less weightage, the longer one have more weightage, because longer means more risky. You don't know what happens. And this is nothing else but the present value of your bond. The weighted cash inflows times your present value of bond will give you the duration. Okay. I think you not worry about the formulas. I think on Excel, you can do everything. Okay. So this is an example I gave you. This is a how many years? 6 years bond. This is a 6 years bond. These are the coupon payments, future cash flow or face value. These are the respective weights, and the duration is 4.03 years, which means a bond which has a tenure for 6 years. It has a duration of 4.03 years, means beyond that, the sensitivity of bond prices to the changing interest rates is minimal or ignorable. They are not significant. That's how you can look at this interpretation. I have one more example. This is actually for 2 years bond, but coupon payments are 6 months. Okay. And when I did that, the answer is 3.77. divided by 2, that gives you 1.89, which means 2 years is the tenure, but duration is 1.89. Beyond 1.89, I think there's nothing to lose from the bond kind of interpretation. So you can use happily calculate duration on Excel instead of working on the formulas. It's quite easy. I gave you this. When you go back home, you can revisit this Excel works so that you'll master it. More examples, these are available in your textbook also, just go through them. Okay, now question is, when does investors like high duration? 10 years is the bond tenure. You want it as 8 years or 9 years or 7 years? It all depends on that price changes actually. Okay, so when do investors prefer higher duration? Okay, they do that when they expect the future interest rates will fall. They want more benefits in future because they are expected to come down. So you will have longer average cash flows and increasing prices. When the price falls, interest rates fall, price increases. The opposite is investors prefer low duration if interest rates are expected to rise, because rising interest rates, shorter average cash flows, and price drops doesn't matter, they're little. So if interest rates are stable, they're not changing, no one cares about duration, it doesn't matter. So using duration, we can also see the price sensitivity. I think in your economics, you have seen elasticity of demand, the price elasticity, income elasticity, cross elasticity. Like that, the modified duration tells you the sensitiveness of changes in yields on the price, changes in price. Okay, that you call it as modified duration. The duration which we have seen, we called as Macaulay duration. By default, if you search for duration, you will get it for Macaulay duration, not modified duration. Modified duration is derived from Macaulay duration or just duration. And finally, convexity is all about the relationship between the interest rates and the prices, which we have seen in the, we have it here also. This is the convexity and this is a duration approximation. Why we have the convexity in establishing the relationship between the interest rates and prices. The prices reflect a change to a given change in interest rates, but not always. Beyond a certain point of time, they react less. That's the reason they're not straight. They are convexed. Okay. So when you apply the same to duration, duration is something you will get because we are taking weights of the coupon payments every year. Okay, so when you take the weights of coupons every year, that is a kind of model you're presenting. But when you look at the bond prices and interest rates relationship, it is what the market speaks. That's what market tells you. Okay, interest rates are increasing, bond prices are coming down. Okay, so I think, did we miss anything here? I think this is important. As interest rates increase or decrease, bond prices change at a non-constant rate, unlike duration. Because at a higher interest rate, a change from 12 to 11%, for example, is different from a change from 11 to 10%. That's what we mean here. So the elasticities are different at different levels of rise or fall in interest rates. that is seen in convexity. So this is more used in portfolios of bonds or other debt securities. And they try to hedge or make it more insured using the convexity when they have a portfolio of debt securities. Okay. See, I think all the bonds are not the same. So you have the maturity here, you have the duration here. Okay. I think we just concluded that zero coupon bond and duration, maturity of a zero coupon bond and duration are the same. This is flat. Okay, they're positively perfectly correlated. But in the case of different bonds where you take 15% coupon payment and 6% YTM, the same thing compared with 15%, you see the difference here. This is lower discount rate means higher prices, so higher duration. And 15%, they are the same, almost the straight line. Your discount rate and your coupon rate, they are the same. There is nothing to analyze here. When you have a bond of 6% and the current interest rates are also 6%, there is nothing to analyze on that. It's the same. But interest rates keep on moving, then it changes. What happened to bond prices if interest rates increase from 6% to 7%? What do you think? Right now, it is 6%. Last month, it was 6%. In December, this month in January 2026, they have increased to 7%. A question to you is, what happens to the bond prices?
Down.
They go down. That's the inverse relationship. That's what we started first. Okay. So similarly, when interest rates come down, the prices will go up. Remember, it applies to both zero coupon bonds as well as coupon payment bonds. Okay. And maybe we talk more about bonds. When you look at yeah, I was giving you this formula. We'll let us see one more formula. Okay. In all the formulas, you see the discount rate is K. Okay. So in the case of bonds, it is merely interest rates, current interest rates, market interest rates or benchmark interest rates. But when it is when you look at valuation of equity securities or shares, it is more than that. You have the required rate of return, which is the benchmark interest rates, which we call it as a risk-free rate of return, which is treasury bond or treasury note. Okay, we take that, number one. Number two, risk premium on the stock. Like I was telling you, most of you are holding technology stocks, right? They're more risky. It means they give you more returns. Higher the risk, higher the returns. That's the relationship. Now, when you said defense stocks, I was looking at some other stocks. There are kind of stocks, defense stocks, where they don't react much to the economic changes. FMCG products, you check the stocks of Walmart or Publix, they don't change much to the economic changes. We call them as defense stocks. So why I'm contrasting these two? Technology stock, defense stock. Okay. When you look at K or required rate of return, one is interest rate, benchmark interest rate. You take a treasury bond or whatever, and you take a risk premium. What do you mean by risk premium? We all know that investing in shares is always risky, but Within the equity, based on the industry you are into, the risk will differ. As I told you, if you pick up technology stock, risk is high. If you pick up defense, risk premium is low, very low, low among all. So you need to take benchmark interest rate, the risk premium, and inflation also. These three put together, you will say that is your K or R, the discounting factor. You got the difference? In the case of bonds, it's only one. Just take benchmark interest rate. But in the case of equity, you have to have more. Some people also include inflation while discounting bonds, but in equity, it is mandatory to include risk-free return, risk premium, and inflation. And you will be learning when you take investments subject, you'll be learning more about efficient markets, CAPM models, what is beta, and so on. So all those people talk about this risk premium, how to arrive at risk premium. You not work on that. The analysts or the brokers or broking houses, they will tell you how to arrive at it. They'll help you. Okay. So is it clear, all of you? This is how we have to understand and relate interest rates while valuing debt instruments or equity instruments. It has all the relevance. Yeah? You have a question? Okay, I think so just cross-check the answers once, all of you. Did we miss anything? I think that's it. Before we close, yeah, any quick questions on this? All are clear? So just let me confirm you again about your assignments for Thursday's session. Thursday 9:30 morning will be the due date for your smart reading for all of you. And assignments and assessments will be on Sunday.
9:30 like the day of class.
Yes. Thursday. Next week, Tuesday's class, Tuesday 9:30. Thursday's class, Thursday 9:30. Yeah. If some of you are late, can you give me your name so that I can give you the roll call?
Yeah. Antonio Justo, JUSTL.
Can you give me your last name?
Yeah, JUSTL.